Good afternoon and welcome to our AutoTalk Summer Series. Our sessions are held every third Tuesday of the month. I am Dan Barson, your host for today's program. Before I introduce our guests, let me review a few administrative items. First, everybody that has registered for today's program will receive a copy at the end of the week. If you should have any questions during today's session, please feel free to enter those in the bottom right corner of your page under the Q&A section. And please stay on the line after the program. We have some special announcements on upcoming events. It really pleases me to introduce today's guests, Aaron and Ryan Kerrigan. They're new partners of ours at AIADA, and we're really pleased to have them. Aaron and Ryan, welcome to the program.
Well, thank you very much, Dan, and thank you, AIADA, for inviting us to present to your members. We really greatly appreciate our relationship with this organization, which does such important work for our industry, and we appreciate the opportunity to be an affiliate partner. Today, as some of you may know, is the summer solstice. So you will see that we're employing a summer theme to our presentation. But before we get going, my partner, Ryan Kerrigan, is going to give you a little update about what we've been up to at Kerrigan Advisors. Ryan?
Thank you, Erin. For those of you that do not know Kerrigan Advisors, we've been able to distinguish ourselves as the most active buy-sell advisor in auto retail in recent years. In the last 3 years, we've represented on the sale of 51 dealerships, including 3 of the top 100 groups in the country. Most recently, this included the Ron Tonkin family of dealerships, the largest private dealership group in the state of Oregon. Our transactions range from large single points all the way through top 100 dealership groups. The reason we've been so active, in our estimation, is the unique way in which we work. We only represent sellers, giving sellers the peace of mind that they have a clear advocate in the sale process. When selling your largest asset, we believe dealers should seek the best representation possible and know that your interests are being represented in the sale process. We only take on a select number of clients and focus on a highly professional and discreet approach to the marketplace. We do not take on listings, but only clients. Our clients are committed to the sale process, and barring some unforeseen event, we successfully transact on virtually all of our client engagements. And finally, we're a fully licensed investment bank, properly registered to represent dealers in the sale of stock, assets, and real estate. We work nationwide and have had the pleasure of advising auto dealers and their families across 20 states thus far. All of this transaction work, coupled with our publications, the Blue Sky Report, and the Kerrigan Index, has resulted in us being viewed as thought leaders in the industry. We are regularly approached by media sources, including the Wall Street Journal and Automotive News, to provide perspectives on trends in auto retail transactions and valuations. With that, I want to turn it over to Aaron, who's going to walk us through the latest trends in the buy-sell market.
Thank you, Ryan. Well, much like riding a wave off the coast of Southern California, where we reside, the buy-sell market of 2017 has been somewhat unpredictable, and perhaps we should not be that surprised. After all, we are coming off a multi-year streak in which auto dealerships have seen tremendous appreciation in value. Now, the best indicator of that appreciation, in our view, is the Kerrigan Auto Retail Index, which tracks the 7 public auto retail stocks. As you can see, between November 2008 and June 2015, the index rose a stunning 968%. Private dealerships likewise saw their values hit incredible levels during this same period. However, coming into 2016, there was much talk about a sales plateau, and everyone has since become quite concerned about the future of auto retail and how it will affect blue sky values. Now, interestingly enough, our industry's prior sales plateau lasted an impressive 8 years, as you can see on this slide, which would put us in the middle of a long sales run. In other words, we're 4 years in. So if this sales plateau lasted 8 years, we still have a lot of running room left. However, that is not how Wall Street is looking at it. The index has dropped 33% since its peak almost exactly 2 years ago, recovering a bit from its lows that were hit in January of 2016, as you can see on this slide. And by the way, those lows were hit almost precisely when Mike Jackson came on CNBC and announced the fact that the industry was entering a sales plateau. But even with the slight recovery we've seen since that time, public valuations are still lower than anyone would like them to be. And with this backdrop, many of us are being asked whether private dealerships are likewise seeing the same kind of decline. Have private dealerships declined in value by 33% as the publics have since June 2015? Interestingly enough, the answer thus far from our experience in the marketplace is no. Private dealership values remain very high. They were high in 2016, and thus far in 2017, we continue to see them on the high side. And this is in large part because earnings are still strong. You will see that they have come down a bit, but only a bit. But importantly, multiples have not. Multiples have remained high. Valuations for private dealerships have been so high that many of the publics have found it difficult to make acquisitions. Public spending on U.S. acquisitions declined in 2016 and is tracking to the same lower level for 2017. At the current valuation levels, most of these companies really struggle to identify deals that are accretive to earnings. If you think about it, the publics really just represent 5% of dealerships, meaning the vast majority of our industry is in the hands of private dealers. As such, when the public's stock prices decline, along with their blue sky multiples, the immediate effect on industry pricing is actually pretty minimal. Public companies are marked to market every business day, and their investors do have the benefit of a highly liquid market. By contrast, dealership owners can often choose not to sell their dealerships or their franchises unless they get the price they want. I can assure you that's what our clients do. In effect, maintaining a pricing floor for private dealerships. Simply stated, private dealers have choices that public shareholders do not. Interestingly enough, even with a sizable decline in public spending, the buy-sell market remains very active as private groups complete ever larger transactions and frankly take advantage of the public's retreat. Buy-sell activity was up in the first quarter of 2017, according to Kerrigan Advisors' analysis of the market, and we expect 2017 to rival 16 and 15 in terms of the level of activity this year. Private companies do continue to drive industry consolidation, as you can see on this pie graph. They acquired 93% of franchises in the first quarter. Now, included in this buyer pool is private buyers is the new entrants to our industry. The family offices, the public conglomerates, the high net worth individuals, the international investors, and private equity firms. Now, I know there's been a ton of talk and certainly a lot of tire kicking, but these folks really are serious about getting into the industry. They just take a little bit longer in their process. And I'm here to share with you that they are not fearful of this talk of a sales plateau. In fact, I think they follow John Mandel's view, which is if this is a sales plateau, as some have called it, it's got a hell of a view. We're finding investors and many large private buyers are comfortable with current sales levels because what they like most about our industry is not our new car department. Rather, it is our hedged business model that usually sustains most economic cycles. Because when new car sales growth slows, the higher margin parts of your business, namely fixed operations and used cars, usually maintain dealership profitability. And that is exactly what we are seeing. With a burgeoning UIO count after record new car sales, growth in fixed operations is exceeding that of the new car department, according to NADA. Though new vehicle sales are the largest portion of a dealership's revenue, they represent about a quarter of a dealership's gross profit. This is due to the fact that gross margins on new vehicles are so low, particularly relative to other parts of the business. The gem of auto retail, the recurring revenue business of fixed operations, garners a margin 5.4 times higher than new cars and represents nearly half of a dealership's gross profit. Body shops are also great investments and higher margin. Likewise, as more used cars enter the market coming off lease, used car sales volume is expected to rise to all-time records, and the margins on used cars are double that of new cars, making for quite an attractive business model and one that outside capital continues to seek. Now, one topic that is increasingly important to the value of a dealership enterprise is real estate, particularly in a plateauing sales environment. Dealership real estate values are on the rise, and in most cases, they are offsetting any potential slight decline in blue sky value. Just look at our estimate for the average dealership blue sky and real estate value in 2016, which is the left bar, versus the first quarter of 2017. As you can see, average blue sky declined slightly in the first quarter because earnings were down a bit for the average dealer. However, the increase in estimated real estate values, which is based off the rent factor and using a current cap rate of 7%, more than offset the decline in blue sky, resulting in a net increase in the value of an average dealership enterprise. Now, as rents continue to rise, the delta between real estate and blue sky will likely continue to grow. It's important to remember that real estate is valued at a much higher rate than most franchises. So all things being equal, dealers, particularly those who are considering a sale, want their value of their property to appraise as high as possible and are better off if a transaction value is weighted more heavily towards the property. This chart shows the equivalent cap rate to each multiple and makes it quite clear. You can see that a cap rate is simply the inverse of a multiple. So a 7% cap rate, which is about where cap rates are for dealership real estate today, is equivalent to a 14 multiple on those earnings, that rent factor. And a 4 multiple is equivalent to a 25% cap rate. Clearly, the goal is to have as much of your deal in the 14 multiple bucket as possible. However, there is a tipping point at which real estate values become so high that they can degrade the overall value of the transaction. As a general rule of thumb, if your rent to growth is far above 10%, you can expect your multiple to decline because a high rent factor dramatically increases a dealership's risk factors and therefore has a negative effect on value. Now, I want to also point out, however, that rising real estate is not all bad news for buyers because real estate financing is generally more attractive than blue sky financing. So the overall return on equity can be very strong in a transaction more heavily weighted to real estate. Okay, now that we've discussed the sales plateau and the effects we see on multiples and values, which we're not seeing much yet, let's turn to the trends we expect for 2017 as outlined in our last 2 blue sky reports. The first trend we are seeing is that buyers' return on investment parameters are increasingly driving which types of franchises they seek to acquire. Buyers are shifting from a prior focus on imports, which is where we saw them focused in 2015, to domestics today, where many buyers expect a higher return on investment, particularly given the current surge in truck sales. We expect that as the cost of capital increases with rising interest rates, buyer sensitivities to ROI will also rise. In this environment, it is not surprising to see buyers shift more noticeably towards domestics and certain imports. Not only do these franchises often require less capital, as you can see here, this graph shows the average blue sky in real estate for these different types of franchises, but they also have higher return on investment expectations due, of course, to their lower multiples, particularly as compared to luxury franchises. In a market focused on ROI, in our view, and based on our analysis, Ford, Chevrolet, Toyota, Honda, and Subaru are likely to see the most buy-sell activity. Think about it. While there is still very high demand for these fabulous luxury franchises that you can see on the right hand of this graph, and many will sell in 2017, Some buyers are concerned over the enormous amount of capital required to make these acquisitions and the lower return on investment expected as a result of the sky-high blue sky multiples associated with them. By contrast, the franchises that are trading at a 4 multiple or under would seem pretty attractive to buyers focused on return on investment, but buyers are keenly aware that these franchises also bring with them more operational risk. So the ROI can quickly go south if you do not know what you are doing. That's not to say that you can't make a ton of money with these franchises. We know lots of dealers that make tremendous amount of money running them. But they're very much the kind of stores that people have to know what they're doing. They're the classic higher risk, higher return investment, which certainly can and will pay off for great operators. But for average operators, I would say buyer beware. That leaves us with the franchises in the middle, which provide a very attractive risk-adjusted return on investment. The variability of these franchise earnings is less extreme than the franchises to their left, and the capital requirement is less extreme than the franchises to their right. For buyers who are highly focused on ROI, we expect they will primarily target the Ford and Chevrolet franchises, whereas more risk-averse buyers with lower ROI expectations and more capital to spend, they will likely target Toyota, Honda, and Subaru. Now, interestingly enough, these 5 franchises in the middle are the ones that are most requested in Kerrigan Advisors' buyer database. The second trend that we see for 2017 is that sellers' pricing expectations have rationalized with a plateauing market. Most sellers are highly aware that the sun has set on crazy blue sky price premiums. And the time when we saw the premiums was in 2015 primarily, when there weren't that many acquisition opportunities and buyers really had a tremendous appetite to do deals. So they were, in some cases, bidding up deals far above the published multiples that we have in our reports. Today, we're seeing that transactions are usually much more inside those multiples, and we are more rarely noticing deals that go far above our published multiples. And that's not that surprising when you think about it, because as the pressure begins to mount a bit on dealership profits. In fact, for the first time in 8 years, dealership profits on average did decline in 2016, and they're down slightly in 2017. There is some sensitivity, of course, from buyers' perspective to their interest to overbid on a deal. They'll pay a fair price, but they're not looking to pay a crazy price. Buyers are also finding pricing more reasonable, I think, in part because sellers are more serious about a sale. Most sellers today do not want to miss their window to sell before the next recession, whenever that is. Also, the market testers who were seeking crazy blue sky values have primarily returned to operating their businesses, discovering those unrealistic prices were not attainable. Now, the top luxury franchises may be the only exception to this rule. The owners of Mercedes, BMW, Lexus, and Porsche franchises, especially in certain markets, are very aware of their short supply. Some well-funded private dealers and some publics are still willing to pay a price premium to add one of these selective brands to their portfolio. They view them as great assets to own for the long term. In most cases, however, the publics are priced out of these opportunities, except Penske just did a big one. But other than them, most of the publics are priced out, and new entrants are generally unattracted to the low ROI associated with paying a 9+ multiple. The third trend we are seeing, which is being led by the publics, is buyers seeking investments in higher margin auto retail business segments, primarily used car platforms, collision centers, and in some cases auctions. This diversification strategy is logical on many levels and presents several financial and economic benefits. First, the revenue streams from these segments are often much higher margin. Collision centers, for instance, have an average gross margin of 45%, 5 times higher than the new vehicle margins. Second, these businesses trade at lower multiples than new car franchises. Thus, buyers achieve a higher return on investment. And third, they do not require manufacturer approval or the construction of expensive image facilities, as Penske noted here on his fourth quarter earnings call. But potentially the most interesting reason to invest in these alternative segments is that Kerrigan Advisors has found there is a valuation arbitrage opportunity here, because the profit streams from these businesses can, when they are fully integrated into a new car dealership, receive a full franchise multiple. This is because buyers typically value a dealership as a whole rather than the parts. In this way, a dealer can buy a used car platform at a low multiple, fully integrated into the dealership's business model, and sell it at a high multiple, a classic 1 + 1 = 3 investment strategy. That brings us to the last portion of our presentation today, and that is a discussion of blue sky multiples. Now, Kerrigan Advisors multiples are informed by our sell-side client work, as well as our extensive industry research. These multiples should be applied to a dealership's most recent 12-month adjusted pre-tax earnings, not an average of the last 3 years, which many sellers in our experience would prefer that buyers do. But what we're finding is that from a buyer's standpoint, they expect earnings to decline slightly in 2018, or at minimum stay flat, and are not necessarily looking to price deals off of peak earnings, which often were in 2015. So there's quite a bit of negotiation around this topic of what the value of a store should be based upon, which year. Now, we are often asked why some dealerships trade above our published multiples and others trade below. We find there are really 5 key factors that drive multiples up and down. The first being earnings growth expectations. And this is simply to say that dealerships that are underperforming can, in some cases, receive a higher multiple because the buyer expects to grow earnings quite significantly after the close of the transaction. And dealerships that are overperforming could sometimes receive a lower multiple if the buyer does not think they can sustain the overperformance. Buyer demand is also a factor. If for dealerships that are in high demand markets, such as the Sun Belt, those stores tend to trade at higher multiples, whereas dealerships that are in low demand markets, where there are not a lot of buyers looking for deals, often see lower multiples. Real estate is also important. If a dealership needs a brand new facility, that usually does have a negative effect on a multiple. And likewise, if a dealership is fully image compliant and has an attractive rent factor, that can actually improve a multiple. Market vehicle preference also has an impact. If you have a truck dealership in a truck market, those are usually valued higher than if you had a truck dealership in a market where there are not that many truck purchasers, although today most markets seem to be truck markets. Likewise, if you have a luxury franchise in a market where there aren't very many luxury buyers, you're going to see a much lower luxury multiple on that franchise than you would see if that luxury franchise was in a place like Newport Beach. And finally, market representation. And this is simply to say that single-point markets tend to have higher valuations than markets that are over-dealered. Over-dealered markets will certainly result in a lower multiple. Okay, here are our weighted average non-luxury multiples since Q4 2014, and they are weighted by franchise market share. Now, you will note that the average multiples, interestingly enough, went up considerably right when the Kerrigan Index peaked and have stayed at that level around 4.5 times on average since that time. As I shared with you, we have not seen private dealership group multiples decline yet and don't really expect them to this year, although beyond that, it will be hard to predict. Now, each of these boxes underneath the line graph show you where the changes that were made each quarter for each franchise and how much each of the multiples were changed up or down. Our Blue Sky report goes into great detail regarding the drivers of these multiples, and AIADA will email the full report when they email you the link to this presentation. We've also added an outlook for the multiples, so where we think multiples could be headed, whether it be positive, steady, or negative. And we think this is a helpful indicator as you look at the multiples and the analysis that we provide. The first analysis I want to show you as it relates to non-luxury franchises is our buyer database. Now, we track buyer demand for each franchise at our firm, and you can see here that Ford and Chevy are experiencing increasing demand and therefore warrant a positive outlook. Likewise, you can see that Chrysler franchises are experiencing a declining demand from buyers, and so much so that we have actually initiated a negative outlook on that franchise's blue sky multiple, and it's the only non-luxury franchise that we have that outlook on. As part of our analysis, we also look at sales trends. In this regard, VW and Subaru certainly are making their mark. Subaru is most notable with 61 months of increasing sales. We do have a positive outlook on Subaru. But perhaps surprising to some of you, we also have a positive outlook on VW because we feel they will get through this Dieselgate, and as the largest auto manufacturer in the world, will likely have future success in the U.S. market. For buyers who are willing to take risk, they could find they could pick up these franchises at a very low value and potentially achieve very high ROI in the future. Looking at sales per franchise, you can also see why Toyota seems to always remain on top. Their discipline as it relates to their dealer network is certainly very admirable, and it results in higher valuations for these franchises because, quite frankly, these franchises have the highest UIO count, usually in their market, and therefore the most profitable fixed operations business. Taking all of the analysis together, you can see that we also look at the Moody's credit rating for the manufacturer, and this is an important indicator. In this case, Chrysler's also not winning out. Unfortunately, they are the only manufacturer that is not investment grade, which means that they are more challenged when they raise capital, and the cost of their capital is more expensive, making it harder for them to invest in their dealer network and in their product pipeline. We also look at average dealership profitability, which you can see very highly correlates with buyer demand. Now, quickly turning to luxury franchises, once again, you see that the multiples jumped up right when the Kerrigan Index peaked and have remained at that high level since then, with some relatively small changes since that time in some of the franchises. In our March report, we did make some changes to the luxury franchise multiples. Specifically, we increased Porsche's multiple on the high end to bring it in line with the other top luxury franchises. And we also increased Audi's lower multiple because we felt that Audi stores would not sell for less than a 7 multiple, particularly with their current product pipeline. We lowered Jaguar's lower end multiple, really as a reflection of its low sales per franchise and its expensive new facility requirements. And finally, we increased Infinity's higher end multiple as we felt the improved profit picture for this brand warranted a higher multiple, and they really did deserve a little bit of a higher valuation than their lower multiple brethren to the right. As you can see, our analysis of buyer demand for luxury franchises really shows a have and have not scenario, although we will say that Volvo appears to be on the rise with more buyers requesting information about Volvo. In terms of sales changes, with the luxury market down year over year, any franchise that has grown their market share is quite impressive. And as great as Jaguar looks here, though, I will say don't get too deceived because it's a little bit of a law of small numbers. Even with 100% improvement, they are still at just 113 new vehicle sales per franchise. Once again, Lexus wins out on this graph with an impressive average of 1,300 new vehicles sold per dealer. Their discipline with their dealer network really makes those franchises tremendously valuable. Lastly, with Moody's credit rating for these companies, you can see that that most of these franchises do have an investment grade, and there is a correlation between a strong balance sheet of the manufacturer and the value of the franchise, as well as a high correlation between the profitability of these dealerships on average and the demand from buyers. Well, in closing, a famous surfer, Laird Hamilton, said that surfing is one of the few sports that you have to look ahead to see what's behind. I would say auto retail is not that dissimilar. We will not know if 2017 is the peak year for buy-sell activity and blue sky values until it is past, and we certainly do not know when the next downturn is coming. But what we do know is that this market has been riding a very nice long wave, or a plateau perhaps. And I think we all hope that it will continue for some time and ultimately have a smooth landing. But in the meantime, we're going to enjoy the ride and certainly the summer. thank you very much for your time on this webinar. I know we're sensitive to time, and so I'm going to just wrap it up. And if anyone has any questions of Kerrigan Advisors, please feel free to email or call our firm. Thanks, Dan.
Erin, thank you so very much. This was outstanding material. Again, for everybody on the call, we'll be sending out a copy of today's presentation. You'll get that by the end of the week, as well as the abbreviated version of the Blue Sky Report. So look for that at the end of the week, and you should have that by Friday. I want to give everybody on the call a quick Washington update. Some very important developments. Last week, AIADA was invited to the White House to meet with the National Economic Director, Mr. Gary Cohen. Attending were Howard Hakes, AIADA's Vice Chairman. Howard is from Point of Hills Toyota. Also President of AIADA, Cody Lusk, and Vice President of Government Affairs, Rachel Robinson. Hakes conveyed in conversation, and he made it quite clear that the dealers are very supportive of pro-growth tax reform, but in no way do we support any initiative that includes a bat. So Howard and team made it quite clear that they are completely against a border adjustment tax. So just a quick update, if you want any additional information pertaining to that meeting or any development around the VAT tax, please give us a call at AIADA, 1-800-GO-AIADA. Now, let me give you a quick preview on some upcoming programs. On July 18th, we're going to have our used car guys back. We'll have Mike Rossman and Bob Grill, and they will present the power of used cars in a declining new car market. And then on August 15th, we're going to feature Charlie Vogelheim, an old industry veteran. Charlie's been around, worked for KBB for a number of years, and he will be presenting Silicon Valley Reinvents the Wheel. So watch for those two programs. We hope you can join us. Again, thank you for your time today, and we look forward to seeing you on the next program. Great selling, and again, thank you for joining us. Bye-bye.